Good morning, everyone. I hope you had a good time last week to review the topics we covered in the first four chapters, and you did well in the exam. I wish that if you get a chance, send me emails telling me your feedback on the material we covered so far and how can we improve the material over the coming weeks, because this will help me actually when I prepare for the new topics. Today I'm going to talk about a new topic, which is business combinations. And in this topic, we will talk about mergers and acquisitions and how they happen in real world and the accounting part in each transaction. This topic is going to cover several chapters with us, and I hope you will be able to make all the consolidated financial statements by the end of the semester. Uh, Today, we will start talking about the different types of business combinations, and we have usually three types. The first one is horizontal integration, where we can see two companies from the same industries, they come together, like Heinz and Kraft or Exxon and Mobil. This kind of combination or consolidation, we call it horizontal. So people are in the same industry, they combine together, or people on supply chain or supplier customer relationship, we call it vertical integration. For example, the combination of CVS and Caremark. This is a good example of vertical combination. The other one, we call it conglomeration. And here we find two different companies from two different industries. They come together, like the utility companies going with telecommunication companies to start a new kind of combination. We usually prefer conglomeration to reduce the risk of the operation. So if one industry falls down, the other one can survive and make the life of the whole operation surviving over the long run. So this is the different types. The legal forms of combination, we might have either merger or consolidation. In merger situation, we assume there is a big company, for example, A company is going to acquire the stock of a B company, but the subsidiary or the B company will disappear and A will remains. In this way, we call it merger. For consolidation, both the parent and the subsidiary, they disappear and a new company will come out, which is, in this example, C company. So we have three types of combinations and two different types of legal forms. And what I'm going to do now is to show you briefly the journal entry, how we record the combination in the books of the company. So in the accounting side, we usually try to measure all the financial statements or the balance sheet items of the subsidiary company at the fair value. So in the example, I give you the book value and the fair value. What you need to do is ignore the book value, but you take the fair value of the subsidiary. And then the parent company issue some shares and give it to the subsidiary company. Here, if they pay extra money for registration of new stock, we record it in the additional paid in capital. If the parent company pays any money for combination cost, for indirect combination like consulting, management, accounting, legal cost, all of this we put it as an expense. And then if the company pays more than the net assets of the subsidiary, when I say net assets, I mean total assets minus total liability. If the parent company pays more than the net assets of the subsidiary, then we record the difference in the goodwill. If the parent company is paying less than the net assets, we call it gain from bargain purchase, and this one is recorded in the current income. Now, let us see a brief example to see how can we record. So, for example, here, a pop company, they issue 100,000 shares of $10 par value common stock for Sun Corporation, where the fair market value of the share is $16. So you can see here the difference between the fair value of the share and the par value is $6. we debit investment in Sun Corporation by the total amount. You credit common stock by the par value and additional paid-in capital by the difference. And then the company pays $80,000 for consulting fees and $40,000 for registration of the stock. The $80,000 will go under expense, but the $40,000 for registration, it goes under additional paid-in capital. And then we make the journal here to recognize the investment, where we put the fair value of the subsidiary company like receivables, inventories, plant assets. We put the fair value of these assets in the debit side and the fair value of the liability side in the credit side, and then we see the difference between them. If the company pays more than the net assets of the subsidiary, we put it in the goodwill. Otherwise, if they pay less, we put it in the credit side, which is gain from bargain purchase. So here we look at the financial statements of the Sun company. So we take here the book value and the fair value. As I mentioned earlier, we ignore the book value, but we take the fair value. And here you can see the fair value of the total assets, $1,440,000. The fair value of the total liability, $240 million. The net assets, which is subtracting total assets minus total liability, we get $1,200,000. Then we start to calculate the total at the fair value to see that the goodwill is equal to $200,000. How we record it? First, we debit investment in Sun Company, credit cash, common stock, additional paid-in capital by the difference, and then we record here the closing entry of this combination. So here, as you can see, all the values you see it for the assets and the liabilities here are in fair value. The investment paid in the credit side, $1,400,000, and the difference between the assets and the liabilities, we put it in the goodwill. Now, here we go to another scenario where the company pays less than the fair value of the net assets. So the fair value of the net assets, $1,200,000, but in this scenario, we assume the parent company paid $1 million. So the difference here will be $200,000. This difference will go to the credit side. You debit here investment, credit notes payable, common stock additional, and then you can see here that the credit goes to the gain from bargain purchase, and this one is current income. It doesn't go under comprehensive operating income, but it goes under current income, and this one should be taxable. Later on, if some values differentiate from the fair value of the net assets, then it will affect the goodwill, and this one we call it goodwill impairment, which you can find it in the chapter. So in this chapter, in a nutshell, we will start recognizing the different forms of the combination and how to record either the goodwill or the bargain from purchase, and then we put it either in the debit or the credit side. I hope you find the material easy to understand and able to do the homework of this week. If you have any question, please don't hesitate to ask me, and I will upload the model answer for the textbook exercise on Moodle, so you can go through the examples and see how they are answered in the model answer, and hopefully you will try to learn the game. Thank you so much, and hope to contact you soon. Thank you. Bye-bye.